Cue the drumroll because today we're diving into the exciting world of index funds. For those of you new to the investment scene, you might be wondering exactly what an index fund is. Let me explain. An index fund is a type of mutual fund with a portfolio constructed to match or track the components of a financial market index. It provides broad market exposure, low operating expenses, and low portfolio turnover. These funds adhere to specific rules or standards that stay in place no matter the state of the markets. Investing in index funds is a popular strategy for many investors, especially those who are looking for a low-cost, passive way to invest. Index funds are a great way to get a diverse range of assets without having to buy each one individually, which can be time-consuming and expensive. Now let's dive a bit more into the specifics. Today we're about adding these specific index funds, Vfv and Vdy, to your portfolio and becoming wealthy. When we say Vfv and Vdy, what exactly are we referring to? Well, VFV stands for the Vanguard S&P 500 Index ETF. ETF, which stands for Exchange Traded Fund, is a type of investment fund and exchange-traded product with shares that are tradable on a stock exchange. ETFs are designed to track the performance of a specific index. In this case, the index is the S&P 500. Now you might be wondering, what exactly is the S&P 500? The S&P 500, or the Standard & Poor's 500, is a stock market index that measures the stock performance of 500 large companies listed on stock exchanges in the United States. It is one of the most commonly followed equity indices and is considered to be one of the best representations of the U.S. stock market. The objective of the Vanguard S&P 500 Index ETF is to track the performance of the S&P 500, a benchmark index of 500 of the largest companies in the United States. It's a way to invest in these companies without buying shares in each one individually. On the other hand, we have VDY, the Vanguard Canadian High Dividend Yield Index ETF. Like the Vanguard S&P 500, it's also an ETF, but it tracks a different index. This index is the FTSE Canada High Dividend Yield Index. The FTSE Canada High Dividend Yield Index is an index that focuses on Canadian stocks that are expected to pay out a higher than average dividend yield. Dividends are a way that companies distribute a portion of their earnings to shareholders, and a high dividend yield can be a sign of a company that is financially healthy and profitable. Investing in an ETF like VDY allows you to have a diverse range of Canadian stocks in your portfolio, and the focus on high dividend yield stocks can potentially provide a steady source of income. It's a great option for those who want exposure to the Canadian market and are looking for income-generating investments. So there you have it. We've covered the basics of index funds, delved into the specifics of the Vanguard S&P 500 Index ETF, and the Vanguard Canadian High Dividend Yield Index ETF, and highlighted their benefits and potential drawbacks. This index puts its focus on Canadian stocks that are expected to pay out a higher than average dividend yield. So why should these index funds find a place in your portfolio? Here's why. First off, both VFV and VDY offer broad market exposure. Instead of betting all your money on one company, these funds spread your investment across a wide range of companies. This diversification can help reduce risk and increase potential returns. Secondly, these funds are passively managed. This means they aim to mirror the performance of their respective indexes, rather than beat them. The result? Lower costs for you, the investor. And finally, these funds offer potential for steady growth. While they're not about making you a millionaire overnight, they are about building wealth over the long term. But remember, investing always comes with risks. Before you jump in, take time to understand these risks. Consider your financial goals and tolerance for risk, and don't hesitate to seek advice from a financial advisor. Investing in index funds like VFV and VDY can be a smart move towards building wealth. But it's not just about picking the right funds, it's also about having the patience to stick with your investments and the discipline to keep investing regularly, no matter what the market is doing. So there you have it. A simple guide to adding VFV and VDY to your portfolio and setting yourself on the path to wealth. Whether you're new to investing or a seasoned pro, these index funds could be a valuable addition to your investment strategy. If you found this video helpful, show some love by hitting that subscribe button. Stay tuned for more investment insights and strategies. Remember, the journey to wealth is a marathon, not a sprint. So keep learning, keep investing, and keep moving forward. Until next time, happy investing.